Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another episode of Hustle and Grit. Today on our podcast, we've got Dalia Barsoum. Dalia is a founder of Streetwise Mortgages, Canada's #1 small market broker as ranked by Canadian mortgage professionals. She is also the founder of Streetwise Wealth, Canada's real estate advisory firm. Dalia is a best-selling author of Canadian Investor Financing 7 Secrets to Getting All the Money You Want, a columnist for Canadian Real Estate Wealth magazine, and holds multiple awards, including one of the top 100 global mortgage professionals. Over the years, as a mortgage broker specializing in income property financing, Dalia has developed an exclusive financing methodology called the Financing Roadmap that the Streetwise team has used to help thousands of investors to build and scale up the portfolios of their dreams while managing risk. Dalia and Streetwise's manifesto is to help clients financially prosper through property investing, thereby creating abundance, peace of mind, and time freedom for clients, and indirectly positively impacting the lives of countless others and the communities they support. Welcome to the show, Dalia.
Thank you, Harris. Thank you for the generous introduction.
Well,
happy to be here today.
I'm not gonna lie, I'm reading through this and I'm getting a little intimidated. Those are a lot of accomplishments.
I know it can get intimidating, but honestly, it's just about doing our best every day to help clients, and then the clients recognize and the market recognize, and it's just the response of the market to how we do things. So
you've got a lot of accolades, and I've seen your profile. I've seen like your LinkedIn, a little bit of stalking there. What got you into brokering? Like, how did you become a broker? What's your story?
I worked for the banks for about 15 years, and was doing well with the banks and really aimed to climb the corporate ladder, and spent immense experience in the banks, moving from technology to marketing to strategy to wealth management. And then I got to a point, to be honest with you, where I was not, like, my day wasn't ticking. I felt that I can do more. I can have better control over my time. And the idea of becoming an entrepreneur started to really, fill my head almost every day. And I started, and I knew that I wanted to get into real estate. And I was contemplating whether I get into mortgages or being a realtor. And I had a young family at the time, and I decided, you know what? Mortgages seemed to be very, very interesting. I owned rental properties at the time, and so kind of a flavor of how financing worked, encountered some issues myself, and I thought, you know what, mortgages for income properties seem to be fascinating. I'm going to step into this because I had finance experience. I had rental properties myself, and I would be in the midst of the transaction, seeing everything, and also have better control over my time, because with mortgages, we actually do business all over Ontario and outside of province right here from this desk. So it was more of stepping into this space out of eagerness to do more and help more and have more control over my time, and because I was fascinated by real
Yeah.
estate.
And so then what got you to I think I may know the answer a little bit, but what got you to focus into the investing side of financing as opposed to first time home buyers? Not that you're not doing that, but your focus it's more towards the investing side. So what got you there?
Yeah, I worked in wealth management for 5 years before leaving the bank. And I got exposure to the markets. I saw everything related to financial planning and how the markets performed. And I personally lost money in being in the market, and therefore switched gears to owning rental properties. So when I decided to make the shift to self-employment, I wanted to continue to pursue that passion of being as close as possible to real estate beyond being an investor myself. So that's the reason why I continued to stay in real estate. But again, financing is because I had the finance background, and I also owned rental properties where I got a flavor of financing challenges. But one key thing is I came from a financial planning background, and I saw also an opportunity to combine planning from the wealth management world with mortgage financing, and to help, you know, plan financing for what you want to do versus just get me a mortgage now, and when the time comes for another one, we'll figure it out. And that really spurred my interest, and that's exactly what I did in Streetwise Mortgages. I focused on rental properties as a passion, but I combined what I've learned in financial planning with mortgage financing, and hence the financing roadmap methodology that evolved over time.
Quick 10-second break. Are you finding this podcast useful? Do you want access to more resources just like this podcast? Sign up to one of our online workshops or our mailing list, and we'll send all the information you need right to your inbox. Good advice is hard to come by, especially in a market like today's. Sign up by visiting treadstonelaw.ca/MAS offer, or click on the link below. Enjoy the rest of the podcast. Yeah, so I mean, you're looking at it from, I guess this is the MBA inside of you talking, because you're looking at it. It's not, it's unconventional in that most transactions are transactional, but you're looking at it from more of a relationship, wealth building perspective, where your clients aren't just coming to you for a mortgage, but it's more of a lifetime. How do we get you from point A to point B, or whatever your dreams are, right?
Yes, yes, exactly, exactly. And that's a much richer conversation and much more impactful, because you take the big picture and the goals, and then align financing
Yeah.
with that direction versus
Yeah.
get a mortgage and you're like operating in a tunnel, and that's not
Yeah.
really, in my view, how it should be done.
Yeah, it's like get a mortgage by, I'll talk to you in like 5 years when it's renewing, or 4.5, 3 if you want to break it. But it's not like, let's position you here, then let's see what else other options that you have, and kind of get to work right when you finish the mortgage as well, to see what other options you have to kind of create wealth. So
Yes.
how did you like get into writing? Because it seems like you're a best-selling author, you're a columnist. Like, what got you to publish your first book?
Well, I actually had a coach, a real estate coach, and he said, Dalia, you already know a lot in this space. Why don't you put your knowledge out? And I said, okay, I'll write some blogs and I'll write some stuff. And he said, no, you're going to write a book. And I've never written a book before. And to be honest, he's the one who actually encouraged me to do this. And I remember it was Christmas time, right after Christmas, things like slow down a little bit leading into the new year. And he said, just sit down and start dumping the knowledge that you know on paper. How can you, if you're talking to somebody about planning financing, what would you tell them? And I basically started that way. And I ended up writing a book, like 2 months later. I had a script for my book, and it was amazing because I felt that I encapsulated a lot of the things I knew into like a guide for investors who wanted to know what income property financing is all about. And it was the first Canadian book on that particular topic. And I'm currently working on version 2. So it came really from a place of my coach was pushing me, but also I knew that I knew a lot that I wanted to share, but and then it ended up being through the book as the first way to get out.
So, like, what were, if you could give us, for those guys, for the listeners who may not be familiar with your book, if you could give us a little bit of what the book has, like, what is it about?
Yeah, so this is the book, and Investor Financing: Getting All the Secrets You Want, and it's available on Amazon. It's a self-published book, and essentially, it touches on the key things you need to know as an investor when it comes to financing property. So the type of lenders who play in this space, what do you need to know? I touch on some creative financing strategies. I touch on the best way to take equity out. Then there are special products for income properties that I also talk about. And then I touch a little bit on commercial versus residential financing. So if you wanted a comprehensive view of the financing world from a 50,000 foot level, with respect to income property financing, because you're looking to grow your portfolio, then that would be a great book to fall asleep on at night.
Well, I mean, I don't know if you could fall asleep on that one, because if it's giving you information, there's like a $1 billion hidden somewhere in there. So what is your kind of target reader? Is it somebody who's just starting to invest? Is it somebody who's a mature investor? Who's their target reader?
I've honestly heard from investors who are starting out, as well as investors who are more seasoned, because as much as the language in the book is very simple, I do touch on a lot of things related to income property financing. So it's not really geared for the junior investor or the senior investor. It's geared to give you that comprehensive big picture from a 50,000 level, regardless whether you're starting out or you are midway and you're scaling up.
Okay. So, and I want to change gears a little bit, because I normally ask if mortgage brokers that come onto the podcast this question, and I think I forgot to ask you, but I want to move back to that. I want to ask, what do you feel, given like what you just said, like what makes you like a good broker? What's your kind of value add, your competitive advantage?
We have become really, really, really good over the years, and that's what clients are tell us, in helping clients scale a portfolio at the best cost of capital. So if you have plans to acquire multiple rental properties over time, we know how to talk about where the money is going to come from, how to set up the money to get you there, how to actually structure it in a way to keep your approvals coming with the lenders that give you the best terms on that portfolio. And we know the sequence of how we place the deals to help you scale at what we call the best cost of capital. You can go and get private money and acquire a portfolio, but that's not optimal cost of capital. So that's what we've become good at, taking investors from, hey, I am right now at my first investment or second investment, and I want to grow to 20, 30, 40. How will I get there? That's basically what we're really, really good at. Whether you're scaling into residential or scaling into apartment buildings or land development later, we can get you there. And this is how we operate, using the financing roadmap methodology that we've developed over the year.
I mean, what I've seen, even mature investors, when I say mature in this market, I'm talking about anybody who has 7 to 10 doors maybe. They don't understand, like what you just brought up, the overall cost of capital for the portfolio. They'll look at cost of capital for a specific property, but when you look at like the entire portfolio, the entire story changes, because you've got so many lenders. You've got like A lenders, B lenders, alt lenders, private lenders, and to have that mix and know which property is best where, right? Even though one property, and this is a question I'll throw out to you. If you're looking at an entire portfolio, a property could get a higher interest rate with one lender, but overall, because of that one lender could it get lower interest rates on something else and actually save you money, and you think you're getting a higher interest rate, but you're not?
Bang on. You have to look at the big financial picture at the end of the day. Like self-employed clients, to give you an example, okay? A self-employed client comes to us and says, okay, how much income should I pay myself from the business in order to qualify for my next 3 properties? We're actually able to come forward with recommendations on that front. But prime example, we ask, where are you going to save the most? Like at the end of the day, where are you going to save? You may show or pay yourself less income from your business and save on taxes, and as a result may get a higher interest rate on this mini property, but in the big picture you're actually ahead. Or you go pay a higher tax bill, get a lower interest rate, but we look at the numbers, and again, from a big picture, you're actually paying more. So this is the key when it comes to cost of capital, and it's exactly what you said, Harris. You may pay more on a mini scale, but on a bigger scale, you're actually saving money. And our role in the process is to help you build up that portfolio and optimize financing as you grow. I've seen investors own some large portfolios using private money. You see on the surface that they have 20, 30 properties. I look below the surface. I see, oh my God, high leverage, expensive money paid throughout. That is not a sustainable way to grow. So what we do is different. We'll help you scale, but we'll help you get there using the best sources of capital at the best cost of money.
Yeah, and it's a more robust portfolio, because you want your portfolio to be resilient. So, and in that sense, you know what I would say your biggest advantage. Not that I'm in a position to say it, but I would say you're saying it's your cost of capital. But I feel like with a lot of brokers that I meet in the commercial side, it is a one transaction type of situation. It's treated a lot like residential mortgages too, right? Even more so than residential, I would say. I think that the fact that you can have a meaningful conversation and even talk about or look at the entire cost of capital of the portfolio, I don't think many brokers, in my opinion, can have that conversation around what does it look like. You're going from 5 and you want to have 15. How are we going to build this with the lowest cost of capital? Even though the next building, you know what, you could probably get X, I'm giving you X plus 2, but we're looking at the other 5 buildings that you're going to acquire. So that kind of conversation, I think, first of all, I would argue maybe brokers don't have it because it's a difficult conversation to have. Because a lot of people are like, no, I want the cheapest, whatever the cheapest is right now, and they go cheapest now is X. Then the next building, the cheapest they can get is really high, but it's the cheapest. Had they just gone up a little bit on the first one, the next cheaper would have been cheaper than they're thinking of. So
100%. You know, a prime example of this is a client, let's say, being so particular about interest rate. And we can go and get a cheap interest rate, but hey, there is always fine print. 25-year M could be the reason behind this very cheap interest rate. Guess what? It is cheap. Yes, you're going to save on interest rate, but now your monthly payment is higher on a 25-year M mortgage on a rental property. It's going to eat into your borrowing power for your next deal, which would potentially make it more expensive because your ratios now are tighter. So again, think big picture. And back to your question about the type of value that we add. Harris, we spend an hour to an hour and a half with every client planning financing through the financing roadmap. We talk about their current situation. We talk about their goals. We talk about aligning the sources of capital. We talk about maximizing borrowing power. How are we going to structure the next 3 deals so that they're crystal clear on how they're going to do it? And once they hit that milestone, we plan for the next round. And then we go over questions. We talk about mistakes and pitfalls, and we put things into momentum. So that's like a full planning complementary session for every investor to help them get clarity on how they're going to move forward on everything money related to their portfolio, at least for their next 3 deals.
Okay, so if I'm listening to this podcast, I'm like, I really want to get in touch with Dalia. What's the process working with you? I've got I could be a first-time investor, or maybe I've got 3 properties. What is it like? Do I give you a call and I say, hey, I just want like property, and like what kind of documents? What's like the entire process? What's the experience?
So simply an email to info@streetwisemortgages.com is the way to go, or on our website, there is a contact form. You fill it and we'll receive your inquiry. And then basically we would set you up for a discovery call. We want to learn a little bit about you, answer any early questions you have. And then we start documents gathering through our secured portal. In preparation for this planning session, hour to an hour and a half planning session. And leading to that planning session, we want to know about your goals. We want to know about your finances. We have certain kits that you have to complete to facilitate that conversation. And we walk you through the financing roadmap in that planning session. And some clients want the actual financing roadmap in hand, which we also give away as a complimentary kit. And then we start putting the building foundation in place. So let's say maybe we want to position equity in your portfolio. We will put that in place. Maybe we need to clear your balance sheet to maximize your borrowing power, and we need to shovel certain debts or pay off certain things. Again, we start to put the building blocks into momentum so that when you are ready to put offers out, you know exactly that you're good to go. There are no surprises. It's how exactly it's going to look like, and you're good for the next 3. And once you hit that milestone, we reconnect again, update the financing roadmap, and do it again.
Okay. Yeah, and that's incredibly important. So, especially in a market like today, like you're more confident going into offers if you've got everything planned out for not only where you are and where you're going.
Yeah, there is no time for surprises. There is no time for conditions.
Yeah.
It has to all, and this is why we invest a lot of time upfront with you as a client to mitigate these risks early on. I mean, there are always some things that may come up later, like related to the property itself, which of course we would take a look at before you put an offer through. But again, there is no time for surprises. We collect a lot of things up front. We tooth comb it to a great degree, talk to you about everything. And this way, when you run, everyone's like go fast.
Yeah, I mean, it's like, you have to look at the property, but like you still have to kind of, you can see the people putting in the offers who know where they're going, right? And they know that the next step is just getting this property approved, versus people like who are double-minded in the back there. They're like, well, can I afford this? Can this? Where am I going to pull the money from? And they're trying to figure it out in their mind as they're trying to put in an offer, which could really burn a lot of time. So I want to kind of turn gears a little bit and talk about like the market in general. Interest rates. I mean, every day you open up the news and they're talking about the sky is falling, and we're gonna have like 7 interest rate hikes, and it's going to be insane. And Bank of Canada did raise it 25 basis points, but they also said they'd raise it earlier on in the year, and they didn't. So my question to you is, where do you see the interest rate? Bank of Canada interest rate, right? And I say that because when you're an investor, I mean, you're going different banks, there's going to be different rates over there. But Bank of Canada, where do you see that going towards the end of the year? Where do you see bond yields going? Like, where do you see overall the interest rate market December 2022?
Okay, I will be right back. I'm going to consult with my oracle and be right back. Oh God. Okay. So here is the thing. Okay. Like, out of all of this news and noise, my takeaways are 2 things. Interest rates will definitely go up from here. There is no surprise. Like, we've hit rocket bottom, like the bottom, right? And they will go up from this point onward. What is the pace of these increases? Nobody really knows, because there are so many variables right now that are playing into this decision of when these rate increases take place and at what pace, okay? So you've got the Bank of Canada concerns around inflation, obviously the war, commodity prices, like there are inflationary and deflationary factors playing into the rate directions, but we know it's going to go up. Now, it is likely that the Bank of Canada will kick in rate increases. We don't know at what pace yet to get back to their overnight rate of 1.75. Right now, they're sitting at the half a point. And they've made it clear that they're concerned about inflation, at least in the short and medium term. So they want to, cap that. So rates will go up. At what pace, we don't know. It will likely get back to another 1.75 Bank of Canada overnight rate. Right now, they're at a half a point. So here is the thing with variable versus fixed. And this is what I tell investors. Right now, if we know the rates are going to go up, there will eventually be some impact on qualification. But also, as an investor, prices are and values are at their best right now. Like the market is so hot. So I would do two things. First of all, I would line up capital through line of credits wherever possible, because I would be ahead of the curve in terms of beating any potential, slowdown in the market, and also beating any potential complications to qualification as a result of rate increases. So line up any equity you can through line of credits. It doesn't cost you anything per month. You've got the money sitting and you're good to go. Two, I would look at my personal balance sheet and say, okay, if the rates go up and my rates on a variable rate increase by another 1.75%, let's say, which is like the ceiling, what would that do to my monthly payments right now? Can I actually absorb it? Like, I have to run scenarios. We would run scenarios and say, okay, I have a mortgage on this property. If the rate increases by another 1.75, in the next 2 years, let's say, what would this do to my cash flow? Will this turn my property upside down, or will it be okay at a portfolio level and at a property level? And if it's okay, I would suggest you stay variable. I wouldn't suggest that you go and lock in. Why? Because as investors, we utilize equity heavily in growing our portfolios. And we actually lean on flexibility as investors because we're always moving money. So variable gives you that option. What I would also do is say, okay, where in my personal balance sheet right now can I maybe clear some expensive debts? This way I clear room in my monthly budget so that if the rates increase, I am not like overpaying on top of what I'm paying right now. So so these are the things that I would do. So therefore, yes, rates are going to go up. Should you actually rush and lock in? I don't believe in that. I believe instead you should pause, reflect on what your finances look like, see what your portfolio will do if the rates increase by another 1.75%. And if you can absorb it, stick with variable over the long run. Variable has paid off for Canadians, except for a certain period. And be proactive. Line up your equity through line of credits, clear your balance sheet to create room for any additional increases. And that's basically what I would do.
So, okay, so this is like almost a war strategy.
Long answer, but these are the strategies and that's around.
It's a very insightful, like very, very insightful answer. So you're saying lock up capital. So in terms of any kind of equity lines of credit that you can get, and then move towards potentially doing a scenario analysis of what's your when you say expensive debt, like get rid of expensive debt. What do you mean by get rid of expensive debt?
So let's say you have the simplest one, I would say, let's say a car payment. Okay, you have a car payment that every month you're actually paying $1,000 to service that car loan. If we know that rates will increase and you want to be able to absorb that without locking into a fixed rate, if that loan has a small amount left on it, let's say $20,000 of car loan left, and you're paying $1,000 a month. What I would do is I would take a secured line of credit, pay off that loan, okay? Get rid of this $1,000, and on a $20,000 line of credit, my monthly payment now goes down to like a tiny number.
Yeah.
Even if the rates go up, you know, double,
Yeah.
my monthly payment will still be extremely affordable compared to this $1,000 that I'm paying. So I've now absorbed that rate increase
Yeah.
and created capacity in my monthly budget.
Yeah.
Um, and that's what I mean by revisiting expensive debt and maybe strategically shuffling debt around to create that room.
Okay. And so, okay, now, and this is kind of my last question, and we'll wrap it up that podcast with this. If I'm an investor, like first time investor, I could have 3 properties, 5 properties, whatever it is, and I'm seeing that rates are going up. Cap rates are already like very, very like low. The margins are razor thin. Wouldn't I be thinking with rates going up? I mean, that just eats up any kind of margins. Why would I be investing? Like, should I just kind of wait until the market somehow crashes? I know everybody says it as I've never seen it crash in the past so many years, but that's what everybody's kind of talking about.
Yes, definitely margins are diminishing because for 2 reasons, right? Prices are going up, rates have not caught up as fast. And then now interest rates are going to rise. And if you're going to utilize line of credits or leverage to buy the next property, now margins have even, diminished further. This doesn't mean that you shouldn't invest or sit on the sidelines hoping for the market to turn around or correct. In my view, it means that you need to change the strategy and the type of vehicle you invest in. For example, some investors may invest in private money, like lend in private mortgages, while they wait for opportunities. You borrow at 3%, you lend at 12%, and now you've immediately created cash flow in a passive way. Mind you, the taxation on that income is different from owning a rental, but hey, it's a strategy to work your money. Or what I see on my end is investors utilizing higher like the value add strategy. So instead of buying a property just and expecting it to cash flow as a buy and hold, well, let's now think a little bit more aggressively and do maybe a minor renovation to push the rents up, or to do something to the property to add more units. You have to utilize more value add strategies to bring that rental income up in different ways in order for the numbers to work in the major markets, unless you go a little bit further out. So what I'm trying to say here is that there is a way to continue to invest and make money. If you go and want to buy a cash flowing property in Toronto, that's not going to happen, right? It's not going to happen.
I don't think it's happening now.
Right? In Toronto, you have to be very, very aggressive in terms of adding value, changing zoning. And again, every market is different. So you have to understand the local market you're playing in and what strategy will help you increase your income and ROI in that market. It could be a value add, it could be change of zone, it could be renting to students, I don't know. And it could be just sitting on the sidelines, investing in private money until, things cool off a little bit. But I don't expect things to crash. I think the market will continue. So these are my thoughts on margins and diminishing returns.
Well, that was a very insightful podcast. Thanks for joining us, and thanks for all of your insights. If anybody wants to get in touch with Dalia, they can get in touch with the contact information for her is going to be below. Thanks for everything. Thanks for your time.
Thank you very much for the opportunity, Harris. My pleasure.